You feel it in the air. The same breathless excitement, the same newspaper headlines and digital banners proclaiming a new era of permanent prosperity. The stock you are watching, the one everyone is talking about, seems to have discovered a new law of physics, one that only allows upward movement. You hear the whispers turn into confident declarations. This time it's different. And that right there is the most expensive sentence in the language of speculation. It is the siren song that has lured countless accounts onto the rocks of financial ruin. It is the foundational lie upon which every great market bubble is built, and its collapse is as certain as the turning of the tides. This belief in the unique specialness of the present moment is a profound flaw in human thinking. We are wired to give more weight to our immediate experience than to the yellowed pages of history. The visceral thrill of watching numbers on a screen turn from black to green day after day overwrites the faint academic warnings of the past. The human mind craves novelty. It is seduced by the story of a new technology, a revolutionary business model, or a paradigm-shifting discovery. We want to believe we are standing at the dawn of a new age because it makes us feel intelligent, prescient, and a part of something grand. The crowd convinces itself that the old rules of valuation, of profit and loss, of prudence and caution, no longer apply. They have been rendered obsolete by innovation. This is the grand self-deception. The tape, however, is an unforgiving historian. It remembers everything. It has seen this play before, and it knows exactly how it ends. The fundamentals that govern the movement of money, fear and greed, have not changed in 1,000 years. The technology that delivers the price quotes may have evolved from a chalk-dusted slate to a glowing terminal, but the human heart beating behind the trade remains the same. It hopes when it should fear, and it fears when it should hope. And so, the cycles repeat. Not in identical form, but in identical spirit. Let me take you back to a time of iron, steam, and smoke, the dawn of the 20th century. The air was thick with the promise of industrial might. A financial titan, J.P. Morgan, had orchestrated the greatest consolidation of power the world had ever seen. He took the sprawling empire of Andrew Carnegie and merged it with his own formidable holdings, forging a new entity of unimaginable scale, United States Steel. It was the world's first billion-dollar corporation. The public was utterly mesmerized. This was not just a company, it was a monument to American industrial supremacy. It controlled nearly 2/3 of all steel production. It was, they said, too big to fail. It was different. The story was intoxicating, and the stock was offered to the public with great fanfare. Novices and seasoned professionals alike clamored for a piece of this industrial giant. The buying was relentless. The tape ran hot with U.S. Steel, each tick upward a confirmation of the new era. It seemed that one could not lose money buying this stock. It was the safest investment on the board. I watched the action from the bucket shops. I saw the fever grip the small-time traders. They weren't buying a company. They were buying a story, a dream of effortless wealth backed by the most powerful name on Wall Street. The stock, issued at 38 for the common shares, quickly ran up to over 55. The papers printed stories of clerks and barbers who had made their fortunes overnight. Hope was thick in the air. But I saw something else on the tape. I saw the character of the trading change. The initial powerful, clean ascent began to sputter. The volume would swell on small rallies that would quickly fizzle out. Then selling pressure would emerge, quiet at first, but persistent. The big lines of stock were being distributed, passed from strong, informed hands to weak, hopeful ones. The public, entranced by the story of a new industrial age, was absorbing the shares that the insiders, who knew the true state of the business, were quietly letting go. The price held for a time, tracing a pattern of distribution high on the chart, a plateau that felt like a new permanent floor to the uninformed. They called it a period of consolidation. I recognized it as a period of unloading. Then the floor gave way. It did not happen all at once. It was a slow, grinding decline that was far more painful than a sudden crash. It was a descent that fed on the very hope that had fueled the rise. Every small 2 or 3 point drop was met with pronouncements that the stock was now a bargain. The public, which had bought at 50 and 55, now eagerly bought more at 45, believing they were getting a discount. They were not buying a dip. They were averaging down on a mistake. The tape told the true story. The rallies were feeble, lacking the sponsorship of big money. The declines were sharp and decisive. The line of least resistance was now clearly, unequivocally, down. Within 2 years, the stock that was the symbol of a new era, the stock that could not fall, had collapsed from over 55 to below 9. Fortunes were wiped out. The barbers and clerks were returned to their stations, their dreams turned to dust. They learned a brutal lesson. There are no new eras in the market. There are only new speculators to learn the old lessons. The cycle of boom and bust, of hope and despair, had claimed another generation. This is the nature of the game. Recognizing these grand cycles is the first step toward mastery. It is a psychological skill. I can teach you to cultivate the discipline and the mindset to see the patterns of human behavior as they unfold on the tape. But for the precise mechanics, for identifying the subtle shift from accumulation to distribution, for knowing exactly where, how, and when to execute the trade based on these phases, you need a more granular, structured framework. You need the methods of my contemporary, Richard Wyckoff. He was a master at reading the tape, and his work codifies the actions of large operators into a clear, repeatable methodology. I give you the philosophy of the market's mind. Wyckoff gives you the anatomy of its movements. I have left the link to the Richard Wyckoff Trading Methods channel in the description below. Use it. Use his tools to sharpen the spear point of my philosophy. It is an arsenal that will serve you well. Jesse Livermore, or Larry Livingston as he was known in print, consistently stressed that Wall Street extracts a heavy cost of instruction for every lesson learned the hard way. Fortunately, the core principles he developed to survive these expensive market penalties were captured for posterity by Edwin Lefebvre in the 1923 masterpiece, Reminiscences of a Stock Operator. It stands as the finest possible literary training ground, allowing you to absorb decades of painful operational experience without ever having to risk a dollar of your own capital. To ensure this timeless wisdom translates accurately to the modern computerized arena, we advise seeking out the Max Davidson Annotated edition. Davidson's careful commentary is indispensable for bridging the gap between Livermore's era and ours. A link to this essential edition is provided in the description below. So how does this lesson apply to the screens you watch today? The names of the stocks have changed, the sectors rotate, but the script is identical. The cycle begins in obscurity and neglect. Think of a sector that has been beaten down, forgotten by the market for years. It could be shipping, or agriculture, or basic materials. The news is universally bad. Analysts have long since stopped covering it. This is the period of accumulation. Patient, informed capital is quietly buying shares from discouraged sellers. The price action is dull. It traces a long, flat base on the chart, a foundation being laid in silence. Volume is low, except for moments when selling capitulation creates a spike, a final washout of the weak hands. Then the first signs of life appear. A positive earnings surprise that the market largely ignores. A subtle shift in the underlying commodity price. A new technology that could benefit the sector. The price begins to slowly, almost hesitantly climb. This is the phase where the early smart money gets on board. The public is still skeptical. They remember the years of losses and see any rally as an opportunity to sell and get their money back. The price climbs a wall of worry. Next comes the public participation phase. The story breaks out into the mainstream. The sector is now featured on financial news networks. Magazine covers are written. Analysts who previously ignored the sector now issue enthusiastic buy ratings. The narrative becomes compelling, easy to understand. Demand for copper is insatiable due to the electric vehicle revolution. A new class of weight loss drugs will create a $1 trillion market. The story is everywhere. The crowd rushes in, driven by the fear of missing out. The price action becomes explosive. The chart goes vertical. This is where the amateurs feel like geniuses. Every purchase is rewarded almost instantly. They mock the cautious, the ones who warn of a bubble. They just don't get it, they say. This time is different. This is the most dangerous moment. It is the distribution phase, mirroring what happened with U.S. Steel. The smart money, the insiders who bought during the quiet accumulation phase, are now selling their shares to the euphoric public. The price may continue to make new highs, but the character of the market action has changed. You will see churning, enormous volume with little upward price progress. Days where the market opens high and closes low, a sign of heavy selling into public buying. The narrative reaches a fever pitch of absurdity. Price targets are revised upward to astronomical levels. This is the peak of the cycle. It is the point of maximum financial risk. And just as with U.S. Steel, the decline will begin. It will be dismissed at first as a healthy correction, a buying opportunity. But it will not stop. It will grind down the accounts of those who bought the story at the top, liquidating their hopes one tick at a time. Your job as a speculator is not to predict the exact top or bottom of these cycles. That is a fool's errand. Your job is to identify which phase of the cycle the market is in and to align your actions accordingly. When a sector is in the accumulation phase, you study it. You wait for it to prove itself, to emerge from its base with conviction. When it enters the public participation phase, you ride the trend, but you do so with a clear understanding that you are on a train that will not run forever. You use pivotal points to guide your entries and, more importantly, your exits. You do not fall in love with the story. You are loyal only to the tape. And when you see the clear signs of distribution, the churning volume, the failed rallies, the euphoric headlines, you step aside. You sell your position and you move to cash. You do not try to squeeze the last few percentage points out of the move. The final frenzied leg of a bull market belongs to the crowd and the fools. You must let them have it. Your goal is not to be right at the top, it is to be solvent at the bottom. What if you find yourself caught on the wrong side of the cycle? Let's say you bought into the euphoria. You saw the headlines, you heard the confident predictions, and you purchased a stock in a hot sector, only to watch it immediately turn against you. The story you bought into is still being told, but the price on your screen is telling a different one. It is bleeding, day after day. Your first instinct, driven by ego and hope, will be to hold on. You will tell yourself it's just a temporary pullback. You will search for news that confirms your initial belief. This is a fatal error. The market is telling you that the cycle has turned. You must listen. You must sell. Take the small loss immediately. Do not allow it to fester and grow into a catastrophic loss that cripples your account and your confidence. A small loss is a tuition payment to the market. A large loss is a certificate of failure. Cut the loss, clear your head, and observe from the sidelines. The pain of taking that loss is nothing compared to the slow agony of riding a stock all the way down. Now consider the opposite scenario. You correctly identified a new bull market in a commodity like wheat. You bought it early as it broke out of its accumulation base. You rode it for a substantial gain. But then you got nervous. The move seemed too fast, too good to be true. You sold, locking in a handsome profit. But the advance did not stop. It continued to power higher, week after week. You watch from the sidelines as the price doubles again from your exit point. The feeling is one of immense regret, almost as painful as a loss. You feel foolish. The temptation is to jump back in. You tell yourself, I was right about the trend. I just got out too early. Do not do it. Chasing a stock after you have sold it is a cardinal sin. Your original exit, while perhaps premature, was based on your disciplined rules at the time. To re-enter now at a much higher price is to abandon that discipline. It is an emotional trade driven by regret, and emotional trades rarely end well. The correct action is to do nothing. Acknowledge that you missed part of the move. It is inevitable. No one catches the entire swing. Congratulate yourself on the profit you did make, and wait patiently for the next opportunity, the next cycle to begin in some other corner of the market. Patience and cash are your greatest assets as a speculator. The market is a grand, repeating rhythm, a symphony of human emotion played out in cycles of boom and bust. It is a story that has been told since the first shares were traded. The names of the companies, the popular industries, the technologies, these are merely the stage decorations. The play itself is always the same. It is a drama of hope, greed, and fear. The speculator who immerses himself in the study of past market cycles is not trying to memorize old patterns to find a perfect match in the present. He is trying to understand the unchanging nature of the human element that drives these patterns. He knows that when a certain set of conditions appears, a certain type of human behavior will inevitably follow. He is not a fortune teller. He is a student of history and a realist about human nature. He knows that nothing is new on Wall Street, and that the belief that this time is different is the most reliable signal that, in fact, nothing has changed at all. Your task is to see the cycle for what it is, to respect its power, and to act not on hope or excitement, but on the cold, hard evidence of the tape. Stay disciplined.